Hello, everybody. Thanks for joining me today. It's July 10th. Time flies when you're having fun. That's for sure. And for those of us who are in the market, especially institutional money managers who, generally speaking, have to be fully invested, it's been a pretty good first half of the year. It's been a very nice bull market since October 12th of last year. I guess there's still some holdouts out there in the bearish camp that think that this is a rally in a bear market. And I think the way their argument has evolved, for a while there, it was we're in a recession or there's an imminent recession, and therefore one did not want to be in the stock market. And that this rally that we've had since October 12th was just sort of a delusional event that can occur from time to time during bear markets, where you have substantial rallies and then they fade away as people realize that the troubles for the economy, for monetary fiscal policies and so on aren't over. This time around, I think it's getting harder to make that argument, especially since the economic data has confirmed that the economy is doing quite well. The labor market continues to employ people. And as a result, I think the bearish case has now evolved to, well, the economy is too strong to bring inflation down. And so the Fed really has no choice but to raise interest rates to levels that cause a recession. Willy-nilly, they've just got to do it. They've got to give up on the idea that there's a path that will allow them to provide economic growth and falling inflation. So naturally, this is last week was an important week because last week was basically employment week. We had the payroll employment data, we had JOLTS report, we had initial unemployment claims, and all those suggested that the economy was doing quite well. This week is CPI inflation news. We're going to get the CPI on Wednesday. We get the PPI on Thursday. I haven't seen it yet, but should be out by now. The inflationary expectations survey that the Federal Reserve Bank of New York puts together. So we'll see how all those play out. But clearly, if they confirm that inflation remains persistent, particularly in the core area, then that'll just heighten concerns that the Fed's going to have to do at least another 50 basis points, all told, in the federal funds rate in order to continue to make monetary policy more restrictive in order to bring inflation down. On the other hand, the surprise could be on the downside, and the CPI inflation rate that could continue to moderate. It's been moderating since last summer. And I think where it shouldn't be a surprise is in the services area. We should certainly start to see some significant moderation in the rent component of the CPI inflation rate. Let's look at a quick takes that I did on this subject. Tell me I messed up here. I'm trying to find my, okay, hold on for 1 second. Let's see where it went. There it is, okay. Now let me open up the Zoom. And let me go to share. Okay. It's always something in this business. So this is something I'm working on for the morning briefing tomorrow. I'm working on the global economy and how it's been relatively weak, and yet stock markets have done relatively well. Well, here's the Ardeni Research web page, and let me just make sure I'm sharing it with you. I think you can all see it. If not, let me know. But let me know that you can see the web page. Just all I need is one person jumping in here, and I'll look at the Q&A. But here's the quick takes. And in the quick takes, let's go to the economic week ahead. Okay, thank you very much. I got the feedback that you could. We have to make this interactive. I also had some problems with audio, and I'm told my audio is okay now. Sometimes it's a big echo. But look, this is quick takes. We put it out yesterday, and it's the economic week ahead. We always do that over the weekend, kind of think ahead about what the economic indicators might show for the economy and how that might impact the financial markets. That's really the main point of quick takes, is to be able to respond quickly to the indicators and assess how they're impacting the markets and how they might impact the markets. So there's reason to hope that the CPI inflation rate will continue to moderate. We can see that on a year-over-year basis, which is usually the way we're looking at these comparisons, you can see that the price of gasoline has come down quite a bit. And price of gasoline is important because everybody drives by gasoline stations, fills up the tank. Everybody knows that price pretty well, at least in their neighborhood. And as you can see, the weekly national, let me make it a little bit bigger maybe, because I can barely see it. So the weekly national pump price using the 4-week moving average is down 27% on a year-over-year basis. In the CPI, it's down 19.7 through May. So there's every reason to expect that will be helpful in moderating the CPI inflation rate that we will get on Wednesday. Here's another important development, I think, and that is we know that rent inflation has been persistently going higher in the CPI. So here's CPI rent of primary residence, and then this cockamamie thing called owner's equivalent rent. And both of them together, I think, account for 40% of the CPI. So it's a big deal. And because it reflects all current rents, it tends to be a laggard compared to current leases that are being signed now. And there's evidence from Zillow and Apartment List that inflation is in fact coming down very sharply for rent inflation. So we're starting to see that in the comparison of the 3-month annualized and the year-over-year. The year-over-year for primary residence is 6.2%. Sorry, let's do that again. It's 8.7%, and the 3-month is 6.2%. So there's certainly grounds for expecting that the year-over-year is going to start to. It looks like it's already starting to come down, and should come down in a more persistent fashion, if you will. Owner's equivalent rent is the same kind of story. Then there's, the PPI comes out on Thursday. We like to look at the PPI. Actually has a personal consumption component to it. It does not include rent, so it really reflects it reflects everything except housing, basically. And you can see that that PPI personal consumption is pretty good. It's down to 1.4% in May. June, I suspect it'll be down still further. The CPI, meanwhile, the headline CPI was 4%. Again, this is not the headline PPI. This is the PPI final demand for personal consumption. And we like to compare it to the CPI and the PCED. And the CPI is down to 4%. The PCED is down to 3.8%. So there's every reason to expect that if this relationship continues to be a fairly tight one, this is more likely to come down than the PPI is likely to be going up anytime soon. Then the PPI again comes out. I understand the China PPI came out. I didn't have a look at it yet, but I think it was still very much in the negative territory from the headline that I read. And so the China total industrial production and total industrial products PPI, as you can see, is down 4.6% in May, and the U.S. finished goods PPI was down 0.6%, and they have been pretty well correlated. So it's another reason to expect that we might get some good inflation news, moderating inflation news this week. And then there's this strange relationship here between the consumer price index, the headline rate, and the ISM services prices paid index 3 months ahead. So you push the 3-month ahead ISM index, and you get a pretty good reading of where the CPI inflation rate overall might be heading. It's a little bit strange that it works so well because it is just ISM services. ISM services, by the way, includes construction. But it works. It seems to work pretty well. And if it's right, we're talking about the CPI inflation rate headline being down to 1% by September. Just showing to you you decide whether you think this is a big deal. I think it's worth keeping track of. And so we'll see what happens this week. So I'm in the camp that thinks that inflation has turned out to be more transitory than was widely expected. In the good side, I'm in the camp that thinks that the services inflation rate has been more persistent, but it will come down. It's not going to persistently stay high, and all that can happen. Fairy tales can happen to you when you're young and in love, as they say in that song from Walt Disney. That can all happen without a recession. I don't know that this idea that you have to have recessions to bring inflation down. It's a very common thought, but I don't share that view. The problem is, of course, if Fed officials come around to believe that that they're frustrated that they're not getting inflation down sooner. But they seem to have these speeches where they come across as very hawkish, and then you look at what they're actually putting in their projections for the economy, and the projections for the economy is that they're going to get down to 2% by 2025. So where's the rush exactly? Why is it that every now and then we're not getting inflation down fast enough? I think it's still heading in the right direction, and certainly by 2025, I think we can get it there without a recession. But we'll see how Fed officials evolve in their thinking, and this week's numbers will be important. Let's look at the morning briefings charts. So we go on the website here, and we can open that up, and then it's over here. So this is today's morning briefing, and I addressed the issue of payroll employment as being one of the four components of the index of coincident economic indicators. So the market's been right all along that the employment report is a very important report. It's the first one of the month that really gives us an indication of where the index of coincident economic indicators are heading. And why is that important? Well, it's a monthly indicator that works awfully well as a coincident indicator of quarterly real GDP. So it clearly matters a great deal in telling us whether the economy is falling into recession or not. Looks like the expectations numbers just came out for the Fed. That's what I just got on my screen. Anyways, let's proceed here. So here's the index of leading economic indicators. Looks bad. Looks like a recession's coming. And meanwhile, while it's down sharply since December of 2021, you can see that the index of coincident economic indicators rose to a new record high in May. So there's no recession in there yet. And this should, on average, give us a lead time of about 12 months. So a recession is overdue based on the leading economic indicators. This is the CEI, coincident economic indicators, year-over-year percent change versus real GDP year-over-year percent change. And the correlation's tight, the scales are the same. And right now, they're exactly in sync, where the CEI is up 1.8% in May and the real GDP is up 1.8%. So that's still positive. And we'll see how the numbers come out for June. But so far, the payroll data suggests that we should be seeing another increase to a record high in the index of coincident economic indicators. So here's the four components. You've got payroll employment, all-time record high in June. You've got real personal income less transfer payments. That's was at a record high in May. And because payroll employment times the average hourly earnings times the hours worked is a good proxy for wages. That's our earned income proxy, as you may know. That looks like it's going to be at a record high. The manufacturing trade sales, that's manufacturing and distributor sales. Distributors are retailers and wholesalers. We're not going to know that number when retail sales come out. When retail sales come out for June, we're still going to be looking at the May report for manufacturing and trade sales. But retail sales certainly aren't going to be at a record high, but they've been kind of stalled at a record high now for about 2 years as consumers have pivoted away from goods to buying services. And so I would think that that may continue to be the case. Retail sales may continue to be fairly lackluster. So all in all, this may not be a positive contributor in the index of coincident indicators. Industrial production, same kind of story. It ticked up a little bit in May, but we can look at the payroll data again, and there's aggregate hours worked in manufacturing, and that looks like a flattish number. So it's going to be flat to up a little bit, but still consistent with the idea that the economy is not going into a hard landing. Maybe it's a soft landing, but it certainly isn't a boom. Meanwhile, looking at the payroll data, that was a solid number, maybe a little bit less than expected, and certainly less than the ADP numbers. We have a little study of the ADP versus the BLS numbers in the morning briefing. You can look at the table, and the discrepancies between the two are quite startling. The BLS makes somewhat more sense than the ADP. The ADP got, for example, a big increase from employment in the mining industry. And I don't see that there were a lot more rigs put up or a lot more copper being looked for. Maybe there's more going on with lithium than we realized. But all in all, the labor market remains solid. You can see that household employment rose to I think it actually edged down in June, but you can see that it's still at an all-time record high the month before. And meanwhile, at an all-time record high is full-time household employment, which is a good development. Household employment measures the numbers of jobs. It measures the number of people with jobs, whether they have one or two or more jobs, whereas the payroll data measures the number of jobs. So if you've got two part-time jobs, that counts as two jobs. So again, here's our earned income proxy. This you can compare that to private wages and salaries in personal income, which accounts for a large percentage of personal income. And in June, we know that our earned income proxy went up by 0.8%, which is a very solid reading. And we'll see how much inflation took out of it, but it's likely that inflation-adjusted real wages rose to a new high, which then is a positive for personal income and therefore also for retail sales. But then the question is, personal income can be spent on merchandise, retail sales, or services, and we haven't seen much evidence so far that people are pivoting back to goods. They're still very much focused on services. This is inflation-adjusted wages. You can look at that later on your own. Then I think there's an important point here that wages and salaries are not the only source of income. There's interest income, dividend income, proprietor's income, rental income. They're all at record highs. You put them all together and you got a record high in May, and that's likely to continue to be the case. So that compares to wages. It's not as big as wages, but it's an important source of income. And by the way, this does not include Social Security, which is another source of income. I've done some work, as you know, on the baby boomers, and the baby boomers are probably getting a lot of this kind of income. And in addition, they're getting Social Security. It's taxed, of course, if they're still working. If they're retired, this is still taxed, but it's taxed at whatever their retirement income amounts to. So here's that retail sales story. As you can see, it's been flattish in current dollars. Let's see if I got that right. Yeah, that's in current dollars. And meanwhile, the earned income proxy, which is this one, is going up. But while this used to be highly correlated on a trend basis for sure, you can see that retail sales have been flattish here as people have pivoted to services. We do know that car sales were up a bit. They're up 4.4% in June, and so that should be reflected in retail sales. And then here's what I mentioned before on a proxy, a useful proxy for getting a handle on industrial production, which is one of the four components of the index of coincident indicators. And here you can see the industrial production is this number, and the aggregate weekly hours is this one, and it's kind of in the flatter side. I mean, this is all consistent again with the goods economy being in a growth recession. It's not growing, while the services economy is doing quite well. That's confirmed by the Manufacturing Purchasing Managers Index, which remained weak in June. As you can see, the new orders were still in below 50, as was the production numbers. How about wages? Wages came out, and they were sticky around 4.4% for total wages, which is basically the same inflation rate as we had before. And so right away, the persistent inflation crowd came out. But let's not forget that it is down quite a bit since last summer. Take production and non-supervisory workers, lower wage workers are actually doing better in terms of wage increases. You can see this is 4.7 versus 4.4 for total. And that too has come down. So I think wage inflation is going to continue to moderate. I think that moderating trend is still there. And let's factor in the possibility that wages could very well be rising faster than prices. That's what's been happening here for the past few months. And you can see that we've drawn a 1.2% trend line growth rate for inflation adjusted average hourly earnings going back to the mid 1990s. Remember, progressives and others have been arguing that the American worker has had no increase in their standard of living because their real wages have stagnated. That's not the case. If you take real average hourly earnings using for non-supervisory workers, which is about 80% of workers, and divide that by the total headline consumption deflator, you actually have a very solid uptrend of 1.2% real. That's a substantial increase in real purchasing power and real standards of living. And we kind of stagnated on that during the pandemic, but now we're back rising. So that's an important source of income, of purchasing power for the consumer. So even if they run out of excess saving, I think we just go back to the old traditional way of what drives consumption, and that's real wages. Again, some of the pessimists I saw jumped on the downward revisions to payroll employment for the past few months. But even with those downward revisions, we have very strong employment gains on a monthly basis. Look, the labor market's strong, and Powell has often focused on the JOLTS job openings, and they remain high. They dipped a little bit in May. Talk about a lagging indicator. May is the latest number we have. But we have more current data like small businesses with job openings, and that also remains historically high. We have the Jobs Plentiful survey, that's this one, which remains historically high. We have the quits, which went up. So the labor market remains tight, but I'm not convinced that we need to have a significant, any recession really, to bring wage inflation down, to bring price inflation down. And but this week will be kind of an important week. As I pointed out in another quick takes, there seems to be sort of there seems to be an upward channel in the S&P 500 since the bull market started. And we're at the upper end of that channel. If we get some remarkably good low inflation numbers, we could break out to the upside. My thinking is we'll get numbers that are sort of don't really resolve the debate. Will convince some people like myself that inflation is moderating and others not so much. I wouldn't be surprised if the market kind of retests 4,200 on the S&P 500 for a while, but the channel gets us up to 4,600 to 4,800 by the end of the year, and that's kind of where we're thinking the market's heading. So that's our story. Let's do some Q&A here. Let me see what we got. So, Ian, what's your take on the Fed requiring more capital for banks over 100 billion? Seems to me the FDIC needs much better oversight in California. Yeah, that's not just the FDIC, it's also the Fed has responsibility for the banks in California. And the San Francisco Fed was so much into diversity, equality, and and those kind of issues that it seems to have forgotten its mandate, which is to make sure that the banks are sound. But look, I think this mid-sized banks, the regional banks, they are going to get regulated more. They are going to be required to have more capital. It didn't stop the large banks from functioning. They've already been doing this, and they're generating business and profitability and making loans. So I don't see that this is necessarily a troublesome. But if you're a small bank and you've got all these regulatory costs, that might actually force more M&A activity. Yellen has mentioned that she's expecting more M&A activity on the part of smaller banks, and that's kind of what I expect. So, when the banking crisis first hit, the knee-jerk was, here we go, wondering which is the next bank that's going to blow up. And that really didn't happen. It didn't last very long because the Fed came in with a liquidity facility that seems to have calmed down everybody pretty quickly. Now I think hasn't started yet, but at some point here, I expect to see that more of us are going to be thinking, okay, which small bank is going to be acquired? And that might actually be bullish for the financials. For those of you who are looking for the market to broaden out, I think there's certainly an opportunity in financials and even in energy, which has been hit hard by the slow growing global economy. But once the economy grows slowly, the next thing it does is it picks up if it doesn't go into recession, which is not my story, of course. Let's see. Having trouble scrolling. Oh, there it is. Okay, this is William. How do you suppose deflation in China affects the U.S. economy? Well, I don't suppose it. I had that chart that showed you the year-over-year percent change in the producer price index for finished goods in the United States versus the PPI for industrial products in China, and they track each other pretty well. So I think PPI deflation in China could very well show up as PPI deflation in the United States, which then, of course, helps to bring inflation down more broadly at the consumer level. Let's keep going here. Got a couple more minutes to share with you. Dilk says, seems like the feds are doing some QT. They likely haven't stopped raising rates, and money saved by consumers is dropping, with prices overall having risen since 2020, though inflation rate has been falling. Seems like people are going to slow their discretionary spending. Do you not believe this is going to hurt corporate earnings towards Q3? I mean, you in a short paragraph, you basically stated the concerns that are out there quite well. The Fed isn't done raising interest rates. That's the widespread concern now. And the consumers running out of excess savings. You mentioned that. And meanwhile, inflation has been taking all, or at least some, of purchasing power away from consumers. And I guess that could still all add up to a consumer-led recession. I point out that real wages are actually increasing, which argues against that. The employment gains also argue against a consumer-led recession. I'd have to actually see some job losses overall for the economy to be concerned about the kind of scenario lay out. But look, what can I tell you? I got 75% soft landing and 25% hard landing. So I would say your scenario is in my 25%. And of course, that 25% is a relatively optimistic subjective probability, a relatively low subjective probability for a hard landing. I think the hard landing scenario now has evolved from, okay, we're not going into it right away as we thought. That's quoting the bears. But now that the economy is too strong, inflation is not going to moderate. And the only way that they're going to bring it down is by raising interest rates a lot more. That's not my story. Finally, let's do Rob here. What is the main reason you think that the LEI will fail in predicting the recession this time around? Rob, I've done a few times. I've pointed out that if you take the year-over-year percent change and the LEI, and on that same chart, put in the Manufacturing Purchasing Managers Index, the correlation is very, very strong. They track each other very tightly. And I think that kind of confirms my view that the LEI is biased towards the good side of the economy. It's got a lot of goods-related components more than it does services. So I think it's heavily weighted in that regard. And there has been a rolling recession in goods. Meanwhile, there's been lots of strength in services. So that's kind of where I'm coming from in terms of why I'm not as adamant about the LEI being a great predictor of an imminent recession or a coming recession. I think I got two more. Is the draining of liquidity by the Fed a cause of worry for you about the stock market? Well, there certainly seems to be a lot of liquidity in the system. If you look at M2, I've done some work on this as well. The M2 is at least $1 trillion above its trend line, pre-pandemic trend line. So there's still lots of liquidity. I've done some work showing that demand deposits as a fraction of M2 is the highest it's been since the 70s. So M2, which is a measure of liquidity, is the most liquid it's been since then in terms of demand deposits. I've pointed out that the baby boomers seem to be sitting on a lot of this liquidity, and they're in a position to spend it. They're in a position to invest it. So I kind of I would like to point out that the Fed is taking liquidity out with QT, but it put in so much liquidity with QE that there's still, on a net balance, plenty of liquidity in the system. Finally, if the odds are 75-25, what is probability roughly do you think the S&P 500 is pricing? Oh, what's the market thinking about? Good question. I don't know. I kind of doubt that the market is quite as optimistic as I am, though it's had a nice run here. 24% increase is a pretty substantial run since October 12th. So I think it's maybe pretty close to 75-25. Maybe it's 70-30. It's certainly not anticipating a recession. So on that optimistic, hopeful note, let me wish you a good week, and let's get together again next week. Thanks for joining.